Good afternoon, everybody, and welcome back. Cyber Trading University presents our Closing Bell webinar series. Now, for those of you that do not know me, my name is Josh Levitan. I am one of Fausto's day trading instructors here with CTU. Let me get a quick sound check first so I know everybody can hear us loud and clear. All right, great to see everybody. Ron B, longtime student, good to see you, Ron. Leda, Joyce, Bill, Dave, Sim, one of our students here as well. Stephen, Kenneth, Phil, Harold, perfect. All right, guys, well, like I said, welcome back. We here present our Closing Bell webinar series. Today we have a fantastic guest. I promoted very well in our trade room for a very proper reason. A lot of us have issues, especially as traders, when it comes down to taxes, understanding the little nuisances of it, making sure you're getting the best bang for your buck, and that's what our guest is here to teach you all about. So today we have John Polk, our good friend from Traders Accounting. So what John will be going over with us today is exactly the title: How to Escape the Clutches of the IRS. So essentially what you will be going over is the fact of understanding investor tax status. Who here, by the way, are swing traders? Because of course here at CTU, a lot of our focus is put on the intraday market, but how many of us are swing traders right now? Investors. Let's see, Alex, T, Sim, SP, few of you guys. All right, good. So that's exactly what John will be going over. Essentially, understanding everything that you need to know as far as as far as from an investor point of view, understanding the entire tax situation as a trader. Because remember, we practice trading as a business, and that's exactly what John will be going over with you today, alongside the advantages and disadvantages of trading as a formalized business. So he's going to talk a little bit about in terms of IRAs. He's going to talk a little bit in terms of opening up your own LLC, perhaps to kind of go through that as to get a better tax benefit. So essentially who John is he is the entity coach at Traders Accounting. His background was in economics, law, and tax. He graduated from Colorado College with his BA in economics, and then he went on to earn his JD from Stern College of Law. So very well respected within not just the trading industry, but the accounting industry as well. So nevertheless, John, are you there?
I'm here. Thank you very much for having me.
No problem at all, John. The floor is all yours.
Excellent. So, again, I'm an entity coach with Traders Accounting, which means that I spend most of my time helping traders set up entities to save on taxes. And today I'm going to be talking to you about how to escape the clutches of the IRS. As you're listening, there are a couple of things that I have to ask you to keep in mind. The first is that tax law is changing constantly. I do make every effort to keep this presentation as up to date as possible, but before you rely on the information that I present here to make a decision about your taxes, I do recommend consulting either a tax attorney or a tax accountant like Traders Accounting. The second thing that I ask you to keep in mind is that Traders Accounting is not a law firm. We are an accounting firm, so none of the advice I give today should be construed as legal advice. Traders Accounting, for more than 17 years now, we've been helping traders with all aspects of trading and taxes. This includes helping them set up business entities to use for trading purposes, helping them with their tax preparation, internal bookkeeping for those businesses, coaching to ensure they're operating those entities properly, helping them set up self-directed 401ks to take care of their retirement planning needs, and revocable living trusts to take care of their estate planning needs. As you can see, we really try and live up to our motto: you trade, and we do the rest. If you'd like to find a little bit more about who we are and what we do, I invite you to check out our website, give us a call, send us an email, or check out the blog, the address of which is at the bottom of the screen. And today we're going to be talking about the IRS. And as many of you know, the IRS has one and only one job, and this is to take your money. Now, they place the burden on you as the taxpayer to prepare your taxes properly and report that income properly in order to stop them from taking that money. And as a trader, you have a much tougher time doing this than just about anyone else. Now, in the eyes of the IRS, you are considered an investor, and this is a formal tax status. It doesn't refer to how you carry out your trading. But as an investor, the tax code is most definitely not your friend. In order to change this investor tax status, you have to take affirmative steps with how you operate your trading activities, moving into much more of a business style of trading. But currently, as an investor, you pay more in taxes, have additional complicated filing requirements, and have to deal with major tax issues like the $3,000 capital loss limitation and the wash sale rule that can have an incredible effect driving up your tax bill at the end of the year. Now, most people think of investing as putting capital or time towards an activity with an intent to make a profit. But the IRS has a much more specific definition of what investing actually is. The IRS believes that investors typically buy and sell securities and expect income from dividends, interest, or capital appreciation. And they specifically say that investing is not a trade or a business, which has big effects, of course, on how you can deduct expenses related to income you see from investing. So the IRS doesn't really care what you call yourself. They care about how you're organized and how you actually trade. So the default status for everyone listening is going to be investor. As an investor, the tax code is most definitely not your friend. It has some pretty major effects on how you report income, and it has incredible effects on your ability to deduct expenses related to producing that income. And we'll start with the income side of things. As an investor, your income is typically split between three categories. There's capital gain and capital loss, which applies to stock, stock options, and some ETF options depending on the makeup of the underlying fund. There's ordinary income, which applies to spot or cash forex positions, and there's Section 1256 income, which applies to things like futures, some other ETFs, the things of that nature. And we'll walk through each of these in turn and talk about how the investor tax status impacts these types of income. For capital gains, this applies to just about anything you hold and use for personal purposes, pleasure, or investment. And this capital gain structure really favors long-term holding of positions. And so anything you hold more than a year is given long-term capital gains treatment, taxed at either 0, 15, or 20%, depending on what your individual tax bracket happens to be. Anything you're holding less than a year is considered short-term capital gain, and this income is taxed at the ordinary income tax rates. When it comes to reporting capital gains on your tax return, you do so through Schedule D. And most traders and most tax preparers will simply rely on the 1099-B they receive from their broker when they prepare that Schedule D. Unfortunately, this is not sufficient. The IRS requires that whenever you have capital gains, you report each transaction, listing the name of the stock, the number of shares, purchase price, sales price, date sold, and date purchased. And if you don't have all of this information, it can have some pretty negative effects on your tax bill at the end of the year. Unfortunately, brokers are not required to track or report all of this information. And so most traders, most investors, end up having to rely on their personal records for a lot of this information. And if they don't have it, they're just out of luck when it comes to paying that tax bill at the end of the year. Now, tracking this information is pretty time-consuming even if we're looking at 25 trades in a year. But as you trade more and more frequently, the time and effort that goes into keeping these records is just going to shoot up astronomically. On top of this, as an investor, you have to worry about the wash sale rule and the $3,000 capital loss limitation. And a wash sale occurs whenever you sell something at a loss. Then within 30 days, either before or after the date of that sale, you repurchase that same security or a substantially similar one. And for the purposes of these wash sale rules, A substantially similar security includes any option that's on the same underlying position. When a wash sale occurs, the loss on the initial sale is disallowed, and the basis of the replacement position is adjusted upwards, carrying that loss forward. And this can also have the effect of eliminating that loss entirely. But to give you an idea of what this looks like and why this can be so negative for you, we've got the example of a trader who owns Microsoft at $25 a share. And at the end of the year, they go ahead and sell it when it's trading at $23 a share, taking a loss of $2 per share. But they get back into it on January 1st. Now here, we have a sale at a loss. Then within 30 days, a repurchase of a substantially similar security. So the loss on the initial sale is disallowed, and the basis of the replacement position is stepped up. And as you can imagine, it's a pretty big headache to track this as you trade throughout the year, particularly if you work frequently in the same types of contracts. But the biggest negative effect of the wash sale occurs in exactly this scenario where the loss is washed over into a future year. Because in 2015, where you were going to deduct that loss of $2 per share, you no longer have a deduction, leaving you paying tax on income that should have been offset. Meanwhile, that position in 2016 has that loss and it's carried forward. But you don't know what's going to happen for the rest of 2016. As you can see, this is a pretty big headache and can have some pretty major effects on your ability to deduct losses from your trading activities. On top of that, these wash sales can be triggered unexpectedly, because trades in separate accounts can trigger wash sales. So if you're trading in your Interactive Brokers account and you have a loss there, then repurchase that same position in your E-Trade account. This is sufficient to trigger the wash sales, and it's another reason why you can't simply rely on that 1099-B from your broker, because while they may be able to track wash sales internal to that brokerage, they're not going to track it across multiple brokerage accounts. On top of that, these wash sales can be triggered by trades in your retirement account. So if you sell something at a loss in your TradeStation account and repurchase it inside your IRA, this is sufficient to trigger the wash sale rule. That loss gets carried up into your IRA, and really it's locked in place there, where you'll never be able to take the advantage of that loss. So when you have a wash sale, it has some pretty negative effects on your tax return. First, you're misreporting income, because you reported a loss in that previous year that is now disallowed by the IRS. Because you've got misreported income, you now have additional tax that you owe for that previous tax year. And if you happen to discover this before the IRS does, there's the need to go back and amend your tax return to correct that income and possibly pay additional tax on that amount. So these wash sale rules really are a nightmare for investors. On top of that, investors also have to worry about the $3,000 capital loss limitation. And this one is a little bit more straightforward. And I mentioned before that when it comes to these capital gains and losses, the IRS and Congress really favor that long-term holding. Anything that's short-term, it gets taxed at the ordinary income tax rate. So you're paying tax at that ordinary rate. But when it comes to losses from trading, it's a much different story. Now I've got the example of a trader who has a W-2 income of $100,000 a year and a terrible trading year, a capital loss of $100,000. Now most people, they look at this and see ordinary income of $100,000, loss of $100,000, the year's a wash, there should be no taxable income. But because of this $3,000 capital loss limitation, you're left with taxable income for the year of $97,000, and the remaining capital loss is suspended and carried forward to previous years. Now, you are able to carry that loss forward and continue deducting it, but at $3,000 per year, it's going to take you 32 years to write off that entire loss, and that doesn't take into account losses in future years. So this capital loss limitation and the wash sale rule can really drive up your tax bill at the end of the year and cause you to pay a lot more in tax than you should. Now, 1256 taxation is a little bit different. And again, this applies to futures, broad-based index options, some ETFs, depending on the makeup of the fund, E-mini options, things like that. Now on these, they're given a preferential lower tax rate. Your net gain for the year, 60% of it is taxed as long-term capital gain, and the remaining 40% is taxed as short-term capital gain. And this is without reference to the holding period. So if you are trading futures on an intraday basis, they will get this same lower tax rate. On top of this, they're also much easier to report when it comes to filing your taxes at the end of the year. With 1256 gain, you simply file Form 6781 with your tax return, identify the broker, and the net gain or loss. There's no need to list out each trade like you do with stock and stock options. These 1256 contracts are also by default exempted from the effects of the wash sale rule. So you can be selling the same position throughout the year without worrying about whether or not you're going to have a loss that's carried forward. These contracts are also marked to market at the end of the year. So if you have an open 1256 contract on December 31st, it's considered sold for tax purposes that night, recognizing any gain or loss at that point on your tax return for that year. Then you're considered to have repurchased it on January 1st with the current fair market value as the new basis. The third type of income that you can see as an investor applies to Forex transactions. Now, any spot or cash Forex is taxed under Section 988. And under 988, these are considered ordinary income and ordinary loss by default. So with the Forex contracts, you're not going to see wash sales, and you're not going to see any issues with that 3,000 capital loss limitation. You also have the option on a trade-by-trade basis to convert your 988 trades into Section 1256, but this is not a universal election. Rather, with these Forex contracts, you simply make the choice when you open that position whether or not you want ordinary income and ordinary loss to apply or the Section 1256 rules, giving you a little bit more control over how those Forex positions are going to be taxed. So as an investor, you have to worry about properly reporting your income on Schedule D. You have to worry about wash sales impacting your ability to deduct losses from trading stock and stock options. You have to worry about the $3,000 capital loss limitation preventing you from deducting all of your trading losses in that year. And you have to worry about reporting properly any gain and loss you have from Section 1256 contracts or Section 988 contracts. And this is just the income side of the equation for the investor tax status. The other side of the equation is deducting expenses. And as you spend more and more time trading, as you take education courses, as you build your knowledge, your expenses are going to increase. So the question you have to be asking is, are you able to deduct those expenses? And we reviewed all of our clients and identified the following areas where they have expenses related to their trading activities: computer equipment, furniture for their home office, using a personal vehicle to attend educational events, using subscriptions for things like platform and data fees, trading organizations, and periodicals, the expense of trading education, home study, seminars, and trade shows, repairs to computer equipment, the cost of having an office, either a home office or an external office space, bank service charges, office supplies, software purchases, utilities like telephone, internet, and TV, professional fees for things like tax prep and accounting, and then travel and entertainment, most often seen in connection with attending those educational events. and our clients typically see between $7,000 and $35,000 per year in expenses coming from these categories. But when you're an investor, the IRS specifically prohibits you from deducting that expense. As an investor, you can only deduct those dues and subscriptions, the cost of having an external office space, the professional fees. That's really it. Sorry, my transitions broke a little bit there. But so as an investor under the investor tax status, you can only deduct the dues and subscriptions, the external office space, and professional fees. Everything else is specifically non-deductible. On top of that, the IRS makes those three categories subject to a 2% AGI threshold limitation, meaning you can only deduct those expenses that exceed 2% of your adjusted gross income. So for most traders, those expenses are simply non-deductible, leaving you with income from your trading activities and nothing to offset them with. So again, investor is the default tax status in the eyes of the IRS. And as an investor, you are paying more in taxes. When it comes to your income, you are paying more in tax because of the complicated reporting requirements and the wash sale rule and the $3,000 capital loss limitation preventing you from deducting your losses. When it comes to deductions, you're paying more in taxes because you are specifically prohibited from deducting the majority of expenses you have related to your trading activities. And even the ones you can deduct are subject to that 2% AGI threshold limitation. So as an investor, it's important that you work with a tax professional who knows and understands traders' taxation, making sure that they're familiar with the wash sale rules and the deductions that are available to you. At Traders Accounting, we do work with investors, and we help them with record keeping to ensure that the deductions they can take are taken properly. We help them prepare their tax returns to make sure that all income is reported properly. And we help them calculate and report their wash sales for the year. Now, this is pretty good, but it's not really a solution. It's simply making the best of a bad scenario. The better option is to change how the IRS views you and change how you're taxed. And you do this by changing your methods of operation and escaping from the investor tax status. Now, to do this, to change from an investor into a trading business, you will need to take affirmative steps. And once you do this, once you take those affirmative steps and qualify as a trading business in the IRS, you gain some more options, and options that are significantly advantageous for you when it comes to reporting your trading income. And so we've talked about the defaults for income, the capital gain and capital loss, the 1256, and the 988 taxation. But when the IRS views you as a trading business, you gain another option, the mark-to-market accounting method. Now again, this is an option that is only available to you if the IRS views you as a trading business. This mark-to-market election is a change of your accounting method, and specifically a change of how you report your trading gain and losses. It converts capital gain and loss into ordinary income and ordinary loss, which means that when you make the mark-to-market election, losses become 100% deductible in the current year, rather than having to worry about that $3,000 capital loss limitation. It also eliminates the effects of the wash sale rule. So once you've made this election, any losses you take are deducted in the current year. There's never a way for them to be carried forward to a future year, causing you to pay more in taxes on your current year's tax return. Once you've made that mark-to-market election, all trades are mark-to-market at the end of the year. Meaning, again, that if you have an open position as of December 31st, is considered sold, than as if you'd repurchase that on January 1st of the following year. And as you can see, this mark-to-market election is hugely advantageous to you if you've made it properly. The question becomes, are you able to make it properly? And for a currently existing trading business, you need to make this election by the last unextended day to file your taxes for the previous tax year, which means that for 2016, the deadline is far past. And for 2017, the deadline is dependent on the day to file your taxes, either March 15th or April 15th, depending on how you're set up. However, by setting up a new business, you are able to make this election as part of the creation of that business entity, allowing you to get that mark-to-market election in place as soon as possible. And the mark-to-market election does offer huge benefits for trading businesses, but it's an important thing to keep in mind that it is not mandatory for trading business. For a trading business that works with stock and stock options, it's fantastic because it gets you out of that $3,000 capital loss limitation and it gets you out of the wash sale rule. But it's not terribly great if you trade anything else. Yes, if you work with futures and Forex, you get the advantage of that lower tax rate on your profits. And if you were to make the mark-to-market election there, you lose that lower tax rate, instead paying at the ordinary income rates. The same goes for Forex, because you lose the ability on Forex transactions to make the 1256 election. It's also not terribly great if you have a large personal capital loss carry forward, because that mark-to-market election would convert your largest future source of capital gain into ordinary income. So if you're thinking about making that mark-to-market election, you need to make sure that it's the right choice for you in your individual circumstances. So once you're a trading business, you get that option of the mark-to-market election to substantially improve how your income is treated from a tax perspective. Once you're considered a trading business, it also has some pretty huge effects on your ability to deduct expenses related to trading. So as a trading business, you can deduct any expense you have related to trading itself. You can also deduct any expense you have related to running and operating your trading business. So if you think back to that list from before, that $7,000 to $35,000 per year in expenses that the IRS specifically prohibits you from deducting. Once you're qualified as a trading business, you are able to deduct all of it. Deductions related to using your personal computer equipment or furniture for trading. Dues and subscriptions for platform data fees, trading organizations, periodicals, educational expenses, equipment repair, office space, telephone, internet, TV, professional fees, and travel and entertainment. And again, I can't stress this point enough. Simply by qualifying as a trading business, you are automatically opening up $7,000 to $35,000 per year in deductions that you can take. Now that alone is a huge advantage of being considered a trading business in the eyes of the IRS. So these deductions are pretty exceptional. And I think we can all agree that we want $7,000 to $35,000 of additional deductions on our tax returns. But it's important to make sure that we meet the requirements to take those deductions. Now, in the eyes of the IRS, they like to see two things when it comes to taking deductions. First is monthly bookkeeping to show how much you're paying for these various expenses. For some reason, the IRS actually likes to see some accounting done there. But beyond that, the IRS wants to know that you are entitled to claim these deductions and entitled to be taxed as a trading business rather than as an investor. An additional benefit to setting up a new trading business or converting your existing activities to a trading business is that you can also deduct those expenses that you paid prior to being considered a trading business. So right now, if you convert yourself from an investor to a trading business in the eyes of the IRS, you're able to look back at least 12 months and recapture any expense you paid in that time that's been related to trading. Now, this isn't quite the gift from the IRS that it looks like, they do only allow you to deduct $5,000 in the current year, and the remaining excess is then amortized over 15 years. But again, simply by converting to a trading business, you open up these additional deductions and the corresponding tax savings. Qualifying as a trading business in the eyes of the IRS is a pretty tricky subject. But if you're an active trader, if you trade and spend a lot of your time devoted to trading activities, you may qualify. Now, once you qualify as a trading business, you get those additional deductions, and you also gain the ability to provide benefits to yourself as the owner of a small business. In the eyes of the IRS, this is known as being a trader in securities, just their name for the trading business tax status. So to qualify as a trader in securities, we look at the requirements the IRS puts forth in IRS Publication 550. This gives us the special rules for being a trader in securities. And in this publication, they set out 3 tests in order to determine if you meet their requirements. And these tests look at all the trading that occurs under your Social Security number. Or if you set up a proper trading business, all the trading that occurs under the EIN for that business. They also take a look and see whether or not you are trading like a business would. The 3 tests the IRS gives us in order to determine if your trading rises to the level of a trading business are: first, whether or not you're looking to profit from daily market movements in the price of securities and not from dividends, interest, or capital appreciation. Second, your trading activity must be substantial. And third, you must carry on that activity with both continuity and regularity. In order to determine if you meet these 3 requirements, the IRS uses what's called a facts and circumstances test. And in order to determine if you're trading to profit from daily changes in market price, they'll look at the typical holding periods for the securities that you buy and sell. In order to determine if your trading is substantial, they look at the frequency and dollar amount for your trades throughout the year. And in order to determine if you trade with continuity and regularity, they look at the amount of time that you devote to your trading. And regularity, they look at the amount of time that you devote to your trading. Unfortunately, this is really all the information they give us in Publication 550. They don't tell us which holding periods qualify and which holding periods don't. The IRS does not give us a hard target for a number of trades throughout the year or a hard dollar target to reach, and they certainly don't give us a number of hours that you have to reach in order to meet that continuity and regularity requirement. So instead, to get a better idea of what they're looking at, we go to the tax court cases. And we've reviewed the tax court cases and have some recommendations based on those. In order to qualify as a trading business, to meet the holding period requirements, as well as the continuity and regularity requirements, you should be trading on about 80% of the available trading days throughout the year. And that works out to about 180 days per year of actually trading. And on these days, place a trade. Pretty simple. But by doing so, you meet the 3 requirements of being taxed as a trader in securities. And the IRS is most likely going to view you as a trading business. On top of that, you need to be trading while behaving like a business would. And I'm sure you've all have heard the advice that to succeed in trading, you need to behave like a business. Follow your rules, take emotion out of the equation. And this is all absolutely correct. But the IRS has a little bit more specific view of what behaving like a business actually is. They want to see you operating as any other business would, keeping up on entity requirements and choosing the right business entity structure for your circumstances. By doing this, by setting up in a proper business entity and keeping that entity active at the federal, state, and internal levels, you demonstrate to the IRS that you are, in fact, a trading business. and qualify to take those deductions and have those beneficial effects for your income. And the third requirement here, I've said this a number of times already, and I'm going to keep repeating it, because for whatever reason, the IRS loves to look at your monthly bookkeeping as a sign that you are in fact an operating business. Throughout all the tax court cases, and across really all industries, the IRS views monthly bookkeeping as one of the most important signifiers that you are in fact an active trading business, or an active business in general. So when it comes to a trading business, you have quite a few options on the business entity structure that you can go with. Now, each of these entities does have benefits, and each has drawbacks. You simply need to look at them and pick the right one for you in your individual circumstances. The structure can certainly be changed, but this change will have tax consequences. And so it's really best to choose the right structure to begin with. And the most common structure we see for a trading business is a Schedule C trading business. A Schedule C is just part of your tax return where you report profit and loss from a business. This is also known as a sole proprietorship, just a different name for the same tax status. We see these most frequently because they're the easiest to set up. Unfortunately, the Schedule C trading business has some pretty significant downsides, and we really recommend against using the Schedule C for trading business. Because when you're operating a trading business through a Schedule C, you're substantially increasing your likelihood of being audited. Now, this is both from a structural perspective, and the IRS simply audits Schedule Cs much more often than it does other type of business entity structures. But beyond that, when you properly report a trading business through Schedule C, that Schedule C will only show expense. It will not show any income from your trading activities. And as you can imagine, there are few things that raise audit flags more with the IRS than seeing this Schedule C showing only expense and zero income. It's also much harder to keep these Schedule C businesses separate from your individual taxes, partially because you're, of course, filing them on your individual tax return. But beyond that, when it's this informal structure, it makes it a lot easier to justify commingling personal funds and business funds, paying business funds out of a personal account, and things like that. It's also impossible to deduct medical expenses through a Schedule C business. Instead, you take those medical expenses through Schedule A on your personal tax return, where they're subject to a 10% AGI threshold limitation, which, much like that 2% AGI threshold limitation for expenses as an investor, often disallows those medical deductions entirely. A much better option is trading through an LLC. And using an LLC is often the best choice for trading businesses. That's because these LLCs are pass-through entities, meaning they pass through all items of income and expense to the owners of that business. What this means for you is that you get all the benefits of filing as a business, operating as a business entity, without any change on how taxes are handled on your personal return. They're also creations of state law, which means the IRS gives them quite a bit of flexibility while still allowing you to maintain limited liability for all the members of that LLC. Now, the LLCs, they're created at the state level, and there's really no federal rule surrounding LLCs. So instead, the IRS gives them flexible tax treatment, allowing them to be taxed depending on the wishes of the owners of that business. Now, for a trading LLC, having two members in there is going to be the best. And we see the second member often act as the trader's spouse, but it can be a business entity like a corporation or a management trust. But when you have this two-member LLC structure, you can elect to be taxed as if you were a partnership, which gives you complete flow-through of all income and expense on your personal return. It also keeps the character of gain the same on your personal return as it would inside the business. So if you're trading futures in the LLC, you're able to report your futures income at that lower 60-40 split tax rate while deducting all of your trading expenses 100%. On top of this, with an LLC taxed as a partnership, you never pay any payroll tax, unless, of course, you want to pay it for the purposes of contributing to a qualified retirement account. But by default, with an LLC taxed as a partnership, you're able to operate as a business, have your profits come out with the same character of gain, and deduct all expenses 100% without worrying about those payroll taxes. The LLCs do, of course, have a couple downsides, and the biggest of which is that you can't use them to deduct medical expenses. Again, those medical expenses just end up being taken through the personal return and subject to that 10% AGI limitation. You also have no ability to accrue profits inside of an LLC. Instead, you pay tax on any profits yearly, even if you're leaving those profits inside the business. And you also must have two members to be effective, because a single-member LLC is taxed the same as a sole proprietorship and runs into those same audit issues. But so if you have two members in an LLC, and again that second member can be a spouse, another business entity, or a trust, then you gain the benefits of that entity. The Subchapter C Corporation is another pretty good option for trading businesses. And an important distinction I want to make here is that the Subchapter S Corporation is never a good idea for a business entity to use for trading purposes, because that Subchapter S Corporation is going to require you to pay payroll taxes on about 50% of your profits. The corporation, on the other hand, works a little bit differently. The Subchapter C Corporation does have some benefits to offer a trading business, primarily when it comes to medical expenses and retirement benefits for yourself and your family. The C Corporation is also considered a complete standalone business entity, meaning that it does pay its own taxes on a yearly basis, but can also act as the second member of that trading LLC. The corporation is going to be the best option if you'd like to pay yourself or your family a wage. And because it's the best option for paying a wage, it's also the best option to use for making retirement account contributions on behalf of yourself, your spouse, and your children. But really the biggest additional benefit that corporation offers is what's called a medical expense reimbursement plan. And this plan does exactly what it sounds like. Allows you to reimburse yourself for any out-of-pocket medical expenses you have throughout the year and deduct those 100% against your trading income, unlike both the LLC and the sole proprietorship, where medical expenses are subject to a 10% AGI limitation. So by using that corporation, you do gain some pretty huge benefits when it comes to benefits. The corporation does have downsides. It's pretty tough to take profits out of the corporation without paying yourself a wage. And if you pay yourself a wage, you end up running into payroll taxes. If you take the option of paying yourself a dividend to avoid the payroll taxes, you run into the double taxation issue, where you pay tax first at the corporate level, then at the individual level on your dividend income. And of course, it does pay its own taxes. So with a corporation, you're filing your own tax return and making quarterly and often yearly tax payments for that corporation. It is possible to combine both the corporation and the LLC and get the benefits of both. Because we're accountants, we've cleverly named this the combination entity structure. And under it, you have a corporation that exists to provide benefits and to pay expenses. Then you have an LLC to generate income. Pass just enough income up into the corporation to pay those expenses and then allow you to make retirement account contributions or provide medical benefits, then passes the remainder of those profits out to you with no payroll tax due on those trading profits. So by using this corporation and LLC combination structure, you really get the benefits of both while avoiding a lot of the downsides to those business entities. When it comes to qualifying as a trading business with the IRS, by using a formal business entity, it allows you to provide a clear distinction between business trading and personal trading. So your active business trading versus your long-term personal investing. It also gives you a clear breakout between expenses and a much lower audit risk from trading as a Schedule C. You can also deduct previously paid trading expenses, bring them up into that new business, and deducting them moving forward. So once you've created this business entity, it's important to make sure you keep it active. And keeping it active means filing annual tax returns for that business entity, filing state tax returns for that business entity, and often regular state reports letting the state know that you're still in business. Of course, my favorite requirement, monthly bookkeeping. And by keeping your books on a monthly basis inside these formal entities, it really helps keep that entity active in the eyes of the IRS and keep allowing you to deduct expenses as a trading business. So at Traders Accounting, our main business is helping traders inside these business entities. And we help them by doing their monthly bookkeeping, keeping track of trading profits as well as expenses. We help traders select, create, and operate the proper business entity structure for their individual circumstances. Help them prepare the tax returns for those businesses, help them calculate wash sales if they need to, and help them make that mark-to-market election so they can avoid wash sales forever. We also help with tax and entity-based consulting to make sure that you're operating things properly and not running into any unseen tax pitfalls. So I know I've run over a lot of information today, and a lot of it's been pretty technical. And so we do offer a free 30-minute consultation to go over some of these questions and talk about how they apply to you in your individual circumstances in a lot more detail. So if you're interested in scheduling that free 30-minute consult, give us a call, send us an email, and we'll get that set up. And I want to stress that the point of this call is to see if we actually can help you save money on taxes. Because we certainly don't want to help you set up a business entity structure that's going to cost you more money than it's going to save you. So if you want to discuss your individual circumstances and which one of these entity structures can help you, please let us know and we'll get that consult scheduled. So today, we've talked about a couple of different things. First, in the eyes of the IRS, you are considered an investor. And as an investor, you are treated terribly by the tax code. You have to worry about wash sales. You have to worry about the $3,000 capital loss limitation. You have to worry about the fact that your expenses related to your trading activities are severely limited, and the complicated reporting requirements for your trading income. So if you are trading as an investor, you need to make sure that your trading is being reported properly, that wash sales are being calculated correctly, and that you're deducting those few expenses that you can actually take. It's only through affirmative steps that you can escape the investor tax status and escape the clutches of the IRS. The easiest affirmative step to take is by setting up and operating through a business entity. So by freeing yourself from the wash sales and the $3,000 capital loss limitation, by being taxed as a trading business, you can escape those effects of the IRS and that investor tax status. You can remove the limitations from your deductions, and you can take advantage of the perks of being a small business owner. So that's going to finish the substantive portion of my presentation. We do have some handouts available, and you can send me an email at ravenj@tradersaccounting.com to get slides, some more full listing of the expenses you can deduct, and a longer explanation for the trader and securities requirements. And I do think I have a couple of minutes left, and I see some questions that are coming in, so I'll answer as many as I have time for. Now, Ron asks, you talked about paying taxes for an IRA. How can that be? Now, the big tax issue with IRAs comes into play with the wash sale. And so trades in an IRA can trigger wash sales on your personal trading account. So, for example, if you sell Microsoft in your personal E-Trade account, and you take a loss of $10,000 on that trade. Now, ordinarily, you'd be able to use that $10,000 to offset gain from other trading activities. However, if at the same time you sell Microsoft in your personal account, you buy it in your IRA, the wash sale rules can be triggered. Now, this means that that $10,000 loss, which should have been taken on your individual account, ends up being carried up into that IRA. And once that loss has been washed into the IRA, it's really stuck there, and you're never going to be able to use it to offset income in your personal account. And I just can't stress enough how devastating that wash sale rule can be, particularly when it impacts your trading in the context of an IRA. Mary asks, same thing for a 401k trading account. And absolutely, any trade that occurs under your Social Security number, so this would be anything in that 401k or IRA, can trigger the wash sale rule. Dennis asks, how do you deal with an unrealized capital gain when you convert to a trading business? Now, the conversion from an individual trading account to a business account does count as a realization event for any positions that you're moving into that trading business. That definitely can be an issue. Michelle asks, I already have a corporation set up for other businesses. How do I treat this separately? And in that circumstance, it's often best to have the corporation act as the second member for your trading LLC, so that you're still able to take the benefit of the trading income flowing out to you with no payroll tax due while deducting expenses through that corporation. Well, that one can be a little bit tricky, depending on what those other businesses are, whether you have employees and things of that nature. But that's really a perfect example of a good topic for that 30-minute consult. Let's see. SP asks, does one have to select mark-to-market for each tax year? And no. Once you've made the mark-to-market election, that is it. It carries forward unless you choose to unelect it. Jerry asks, are you fee-based? And we do charge a fee for setting up these business entities as well as preparing the tax returns. If we're setting up a business entity for you, it's going to vary from state to state depending on the state filing fee where you're at, but typically this costs $1,995 plus that state filing fee. And with that, we build the entity that you need. We have 3 scheduled coaching sessions walking through setting up the entity, moving over your existing positions, and whether or not to make that mark-to-market election. Then we'll do the first 6 months of bookkeeping for you, as well as prepare the first year's tax return, all as part of that initial price. Past that, When it comes to tax prep, we charge $200 an hour. Larry asks, if we use a direct access platform to trade, can you assist us with putting together the wash sales that the broker used to? Absolutely. We can perform wash sale calculations across all of your accounts and prepare reports showing your actual gain or loss for the year that you can then use for preparing your taxes. SP asks, can one select mark-to-market at any time for an LLC? And you can make that mark-to-market election for a newly created business as part of that creation. So if we form an LLC tomorrow, we can make the mark-to-market election at that point. But for an existing LLC, the mark-to-market election needs to be made by the last unextended date of filed taxes for the previous tax year. So if you've got an existing business and you want to make that mark-to-market election for 2017, the last day to make the election is going to be March 15th of 2017. The last unextended day to file your taxes for 2015. Charles asks, where are you located, and are you a CPA? We are located in Phoenix, Arizona, but we do work with clients all across the country and a few clients that are spread out across the world. And we are not a CPA firm. We are just a standard accounting firm. We have several EAs on staff, and then while I am a tax attorney, again, we're an accounting firm rather than a law firm. But that does look like all the questions I'm going to get today. So I want to thank you all very much. One more question. Charles asks, what is your success rate at audits? And while I've been here, we've had a 100% success rate when it comes to the IRS audits. Admittedly, I've only been at Traders Accounting for 4 years now, but in that time, we've seen 100% success. And one of the reasons for that is that we make sure that when we set these things up, we get everything in place properly from the get-go, making sure that you have the requirements necessary to be taxed as a trader in securities, and more importantly, that you have the records necessary to show the IRS exactly how you're operating and why you're entitled to be taxed as a trading business. But again, I want to thank you all very much for having me tonight. Hope I was able to give you some good information, some things to think about, and I hope to have the opportunity to work with you personally in the near future. Again, thank you very much, and have a great evening.